What really happens when someone files for bankruptcy in the United States? Is it the end of the road financially, or can it actually be a new beginning? For millions of Americans burdened by debt, bankruptcy seems like a frightening concept, but the truth is far more practical and surprisingly hopeful. In this video, we'll walk you through the entire bankruptcy process. What it is, how it works, what the consequences are, and how life can look after filing. Whether you're facing mounting bills or just curious about how bankruptcy works, you'll find clarity here. Let's start with the basics. Bankruptcy is a legal process governed by federal law. It's designed to help people and businesses who can't pay their debts. The goal is twofold. First, to give honest debtors a fresh financial start. Second, to ensure fair and orderly repayment to creditors, at least to the extent possible. The process is overseen by a bankruptcy court and involves court filings, documentation, and in most cases, the appointment of a trustee who manages the process. Now, there are several types of bankruptcy in the U.S., but the most common for individuals are Chapter 7 and Chapter 13. Let's take a closer look at each one. Chapter 7 is often called liquidation bankruptcy. It's the most commonly filed type for individuals. When you file Chapter 7, the court appoints a trustee who reviews your assets and liabilities. If you have non-exempt property, things that aren't protected by law, it may be sold off to pay your creditors. But here's the key. Most people who file Chapter 7 don't lose their essential belongings. That's because many assets are exempt under state or federal law, such as household goods, basic clothing, some equity in your home, and retirement accounts. Once the liquidation is complete, most of your remaining unsecured debts are discharged. That includes credit card debt, medical bills, and personal loans. But certain debts are not dischargeable. These include most student loans, recent tax debts, child support, alimony, and fines or penalties owed to the government. To qualify for Chapter 7, you have to pass a means test. This test compares your income to the median income for your state. If your income is below the threshold, you can file. If it's above, you may be steered toward Chapter 13 instead. Now, let's talk about Chapter 13. This is known as a reorganization bankruptcy. Unlike Chapter 7, Chapter 13 doesn't wipe out your debts right away. Instead, it gives you a structured repayment plan lasting 3 to 5 years. You continue to pay your regular living expenses while sending a monthly payment to a court-appointed trustee. That trustee then distributes the money to your creditors according to the plan. The big benefit of Chapter 13 is that you can keep your assets, like your house or car, even if you're behind on payments. It's especially helpful for people who have steady income but have fallen behind due to illness, job loss, or other financial shocks. If you complete the repayment plan successfully, any remaining eligible debt may be discharged at the end. Let's walk through what actually happens when you file for bankruptcy. First, before you can file, you must complete a credit counseling course from an approved provider. It usually takes about an hour and can be done online or by phone. Once that's done, you file a petition with the bankruptcy court. This includes a detailed list of your debts, assets, income, expenses, recent financial transactions, and more. As soon as you file, an automatic stay goes into effect. This is a legal order that stops most collection actions immediately. That means no more harassing calls from creditors, no more lawsuits, no more wage garnishments. If your home is in foreclosure, the process is paused. The automatic stay gives you some breathing room and protection while the court handles your case. Next comes the meeting of creditors, also known as a 341 meeting. Despite the name, creditors rarely attend. It's usually a short, straightforward meeting where the trustee asks you a few questions under oath about your finances and your filing. If everything checks out and there are no objections, your case moves forward. In Chapter 7, if your assets are straightforward and there are no complications, you can typically receive a discharge in about 3 to 4 months. In Chapter 13, the discharge comes only after you've completed the repayment plan, which can take up to 5 years. Now, let's address the elephant in the room: your credit. Filing for bankruptcy will impact your credit score, and it will stay on your credit report for several years. 10 years for Chapter 7 and 7 years for Chapter 13. Your score will likely take a hit initially, especially if it was decent to begin with. But if you were already missing payments and defaulting on loans, the damage may not be as dramatic as you think. The good news is, you can rebuild your credit after bankruptcy. In fact, many people start improving their credit scores within a year or two. By using a secured credit card, making payments on time, and keeping balances low, you can show lenders that you've turned things around. Some people even qualify for car loans and mortgages within a few years of filing. Let's quickly break down the pros and cons of bankruptcy. The pros include immediate relief from debt and collection efforts, the potential to eliminate most unsecured debts, the ability to stop foreclosures or repossessions, and a path toward financial recovery. It can lift an enormous emotional burden and help you regain control. The cons? Your credit takes a hit. Bankruptcy is public record. You might lose non-exempt property in Chapter 7. Not all debts can be discharged. And yes, there's a social stigma attached to it. Though that stigma is fading as more people realize bankruptcy is often the result of life events, not bad decisions. There are also many myths surrounding bankruptcy. One common myth is that you'll lose everything. That's not true. Most filers keep most or all of their possessions, especially under Chapter 13. Another myth is that only irresponsible people file for bankruptcy. In reality, the most common causes of bankruptcy are job loss, medical expenses, and divorce, things that can happen to anyone. Another big myth is that bankruptcy ruins your financial future forever. That's just not the case. While it does take time to recover, many people who file for bankruptcy go on to buy homes, start businesses, and build strong credit profiles. Bankruptcy is not the end of your financial life. It's a restart button. So how do you know if bankruptcy is the right option for you? It's a deeply personal decision. But here are a few red flags to consider. If your debt is greater than your annual income, if you're only making minimum payments and your balances aren't going down, if you're behind on major bills like your mortgage or car loan, if creditors are suing you or garnishing your wages. These are all signs that bankruptcy might be a sensible option. Before making a decision, it's crucial to consult with a qualified bankruptcy attorney. They can walk you through your options, review your financial situation, and help you decide whether Chapter 7 or Chapter 13, or another solution entirely, is right for you. In summary, bankruptcy in the U.S. is a powerful legal tool that offers a path out of overwhelming debt. Yes, it has consequences, but it's also a chance to start over financially. The process is structured, transparent, and fair. And while it's not a decision to take lightly, it can be a life-changing move toward financial health and freedom. If you're feeling overwhelmed by debt, know that you're not alone. Millions of Americans have walked this path and come out stronger on the other side. Don't let fear or shame stop you from exploring your options. Financial peace of mind might be closer than you think. Thanks for listening. If this video helped you understand bankruptcy better, don't forget to like, share, and subscribe for more content on personal finance, credit repair, and legal tips that can change your life.